Chapter 3, Term Loans Beyond EMI Thinking. Term loans are a cornerstone of corporate finance, providing businesses with the necessary capital for significant investments and strategic initiatives. Unlike revolving credit facilities, term loans are structured with a defined repayment schedule, making them suitable for long-term funding needs. Section 1. Why term loans exist. A term loan is a structured debt instrument characterized by a predefined purpose, amount, tenor or duration, and repayment plan. These loans are primarily utilized by corporate clients to finance substantial undertakings such as capital expenditures, acquisitions, or to refinance existing debt, thereby supporting long-term strategic commitments. While seemingly straightforward, the underlying risk logic and system handling for term loans are considerably complex. A term loan is not merely a repayment schedule. It represents a dynamic business agreement designed to adapt to real-world changes, including business expansion, cash flow fluctuations, market shocks, and covenant adjustments. Technical insight. From a system perspective, this implies that the loan management system must be flexible enough to handle dynamic changes to repayment schedules, interest calculations, and covenant monitoring, rather than relying on static, predefined amortization tables. Section 2. Business use cases. Term loans serve a variety of critical business purposes, each with distinct risk profiles and implications for loan management systems. First, capital expenditure financing. Companies frequently borrow to fund significant capital investments, such as building new factories, upgrading existing infrastructure, purchasing fleet vehicles, or establishing data centers. In these scenarios, drawdowns, the release of loan funds, often align with asset delivery milestones or project completion stages. Implementation note. Loan systems must accommodate phased drawdowns, where each tranche may have its own interest commencement date while remaining under a single overarching loan approval. Second, acquisition or buyout funding. Term loans are instrumental in financing mergers and acquisitions or leveraged buyout transactions. The success of these loans, and consequently their repayment, is often contingent on the successful integration of the acquired entity and the realization of anticipated synergies. Third, refinancing existing debt. Corporations often use term loans to consolidate or replace a multitude of short-term loans with a more structured, long-term debt solution. This can lead to more predictable cash flows, potentially lower interest rates, and simplified debt management. Fourth, project completion or bridge loans. Shorter tenor term loans can act as bridge financing, providing capital to cover gaps between project stages or to precede the securing of more permanent, long-term funding. These are typically repaid once the long-term financing is in place or a project phase is completed. Best practice. Each loan purpose necessitates a different risk appetite and credit policy. Loan management systems must be designed to capture not only the loan amount but also the specific source of repayment and the end use of funds to accurately assess and manage risk. Section 3. How cash flow-based repayment really works. Unlike retail loans, which often follow rigid equal monthly installment schedules, corporate term loans are predominantly based on cash flow mapping. This means repayment schedules are tailored to the borrower's projected operating cash flows rather than a formulaic amortization. DSCR, or debt service coverage ratio, is a critical metric calculated as operating cash flow divided by debt service, which includes principal plus interest. A healthy term loan typically maintains a DSCR greater than 1.25 to 1.30, indicating that the company's cash generation comfortably exceeds its debt obligations. Repayment frequency. Repayment frequencies are often aligned with expected revenue inflows, such as quarterly, semi-annually, or annually, rather than fixed calendar months. Deferred interest and moratorium. In complex financing structures, such as project finance or export finance, the first interest payment might occur years after the initial disbursement. Loan systems must therefore support deferred interest and moratorium periods. Technical insight. Modern loan systems must feature sophisticated cash flow engines capable of dynamically adjusting repayment schedules based on actual and projected cash flows, rather than static amortization tables. Section 4. Risk scenarios to understand. Corporate term loans are exposed to various risks that can impact repayment and require robust system capabilities for monitoring and management. First, construction delays. Delays in achieving project milestones can directly impact the borrower's ability to generate cash flow, thereby shifting repayment schedules. Such delays often trigger reapproval processes or necessitate loan restructuring. Second, cash flow misses. If a borrower's DSCR falls below predefined covenant levels, banks may impose corrective measures. These can include higher interest margins, demands for partial prepayment, or requirements for additional collateral enhancement. Third, counterparty risk in receivables. Many borrowers rely on payments from their customers or receivables to service their loans. A high concentration of receivables from a few key customers can heighten repayment uncertainty if those counterparties face financial difficulties. Fourth, interest rate volatility. Floating rate term loans expose borrowers to fluctuations in benchmark interest rates, such as IBOR or SOFR. To mitigate this, hedging products like interest rate swaps or caps are often linked to the loan's repricing index. System implication. Repayment tables and delinquency flags in loan management systems cannot be static. They must be capable of recomputing dynamically in response to event triggers such as benchmark rate resets or DSCR breaches. This requires real-time data integration and complex calculation engines. This concludes Chapter 3, Term Loans Beyond EMI Thinking.